All right, so to get started today, you're going to need two files that I posted on the Elms files folder under Costco. One is the start valuation file, Costco start model. The other one is the Costco data file. Now, if you were able to successfully complete the data export from Bloomberg, you can use your file. If you weren't able to complete it, I put a file up there that you could use. All right. What we're about to do, and I will open up the start file here. All right, is that I've given you a starting valuation model, right? Now, I didn't do the whole model because I found in the past that if I just give you a valuation model, it's a black box, you won't know how it works. So you have to build the valuation model that we're going to use this semester as a reusable model tied to Bloomberg. Now, instead of just starting with a blank canvas, I've given you a few things to get us started. That's the file here, but we're going to build together this week and next and create a reusable valuation model, which will take us 2 weeks to build. All right. Once we build the reusable model, it'll take us 10 minutes to do another company. All right. Now, this reusable model is tied to Bloomberg. This first tab, called the Model Data tab, is the data that you created the exported file from Bloomberg. Right? Because in order to use a reusable model, we need standardized statements. Right? Bloomberg, believe it or not, doesn't have standardized statements. Their standardized statements, we have found over time, are not standardized. Because when you go to different companies, the standardized statements have different items on them, which is by definition not a standardized statement. So we've had to create our own standardized statements. So this tab has 80 fields of the raw materials to create the standardized statements. That's what you exported from Bloomberg. So we're tying our model to Bloomberg, which is a great data service, but we're going to use that to help us build the standardized statements to create the valuations. Right? Now, a word about Bloomberg. We are privileged to have 60 terminals at College Park, 32 of them in this computer lab. Right? However, every Bloomberg terminal has a monthly data export limit. And as soon as you hit that data export limit, that terminal will not export any more data until the first of the next month. Given today is October 26th, I fear what some of you ran into over the last couple of days is the data export limits on some of these terminals. Now, unfortunately, we are not alone in using these terminals. The word is out, not just at the Smith School, but the university, about this lab and the value of the Bloomberg terminals. So the PhD students come in here and they basically gobble up all of the data because they also know about the data export limits. So what they'll do is they'll start at one of the terminals, they'll export as much data as they can until it stops, and then they'll go on the next one and feast on their data. All right? And unfortunately, we compete with that and we can't stop that from happening at the university. Right? I wish we had the lab all to ourselves, but we do not. Okay? So we may run into that. If you run into that problem, the only solution is to go to another terminal, right? Either here or downstairs. But downstairs is even worse. Okay? So my only other advice to you is don't tell your friends about this lab. Okay? They don't need to know about it. This is really for the 170 people that are signed up for the class. You're the priority because you need to do it for the assignments. But here's the other thing. Come the 1st of November, everything resets. Okay? So next week, it should be much better. All right? But by the end of November, it starts getting bad again. Now, most of your valuation assignments will start occurring in the beginning of November, but nonetheless, that's one of the issues. The other issue is that Excel on one of these computers has to have the Bloomberg plugin. So when you open up Excel, on the menu, it should say Bloomberg on it. If it doesn't say Bloomberg on it, then you can't export data to that version of Excel. Okay? Because what's going to happen is with the Bloomberg plugin, it's actually pulling data in real time from the Bloomberg data service, which is really cool because you can actually do all of your work in Excel without going to Bloomberg. Just open up your Excel file and instantly all the data is quickly updated. Right? Unfortunately, you can only do that if you have a Bloomberg terminal license, which you will not when you leave this room. So that's the other thing. If you try and export it and for some reason that plugin is not loaded, it won't export. And that's something else we might be running into. So unfortunately, you won't be able to install the plugin because IT has locked down these computers. So if you run into a machine that doesn't have the plugin, let me know so I can ask IT to reinstall the plugin. Okay? So that's the other thing you may be running into in the data file. There's no way around that. So for now, I've given you the Costco data file. When you export the Costco data file, as I said, two things you had to do, which I covered in the video, but number one, as I said, initially, these are not numbers. If you actually hover on these were database lookup fields. So the problem is, when you leave the lab and you don't have Bloomberg, it'll error out the next time you open up the file. So what'll happen is, in order to prevent that, we're gonna have to turn these database lookups into actual numbers. So that's why the first thing was to select the whole tab, copy, paste special values to put those in the numbers. The other thing is, excuse me, Excel chokes on dashes. All right, you can't have a dash in a formula, and we're going to make references to these cells. So we have to get rid of all the dashes. So that was the other thing that you had to do, turn dashes into zeros. So assuming you did that, or you're using my file, here's our first step. Take this Costco data file. The file that I gave you as our starting file has Dollar General data in it. Take the entire first tab of the Costco data, select it, copy it, select the first tab in our model that you downloaded called Model Data for Dollar General in this case, select it, the whole tab, right click, paste special, values. Don't copy paste, paste the values. Those are the numbers. And then, cell for cell, row for row, this file now has all the Costco data overwriting all the Dollar General data. Okay? So this is how we update the model. All right? So this is a very important first step, because if you don't update this Dollar General model, you won't be able to turn in your next homework assignment. So this is the first step. But I also wanted to show this to you because this is how we reuse the model. So if you go to your Bloomberg terminal and you take a different company, AT&T, and you download AT&T and overwrite this, then Costco becomes AT&T. So this is the tab with the raw historical income statement and balance sheet data that we need to build our reusable valuation model. Right? Now, this model that we're going to start to build also starts with a series of other tabs. There's a tab called the Income tab. These are the standardized statements that we will be creating based on that raw material from the data we're exporting from Bloomberg. The next tab is called the Balance tab, which are the historical balance sheets, again, in a standardized format. TFI, you would have appreciated, is the rearranged economic statement of total funds into investors. Now again, because we're using a standardized balance sheet, the TFI will work every time and be rearranged. So you don't have to do this. I'm sure you'd appreciate this on your midterm, but there's the correct balanced TFI. Same thing with the TII is mapped to the income statement. There's the historical TIIs converted, which then create the CFIs. And the next tab is the economic profits. So those four economic statements are basically set to the income statement and balance sheet, which is standardized. That way they auto-complete and should balance. Matter of fact, that's one of the other important things. When you put your new company's data in Costco, go to the CFI tab, make sure it still balances. Right? Now in this case it does, but if it ever doesn't, what's probably happening is on that model data tab, we have discovered 80 fields over time from all the companies that we've used in this class that are necessary to get financial statements from all the companies. But every now and then, we run across a company that has a field that we haven't used before. And it's on their financials. And so what will happen is our CFI won't balance when you put that company's data in because it's missing that field. And so what we would have to do is we have to identify which field we're missing. We'd have to go back to our model data template, add it. That's why you're going to see some random numbers at the bottom of the model data template that just, like, why did I put them here versus otherwhere? Because those are the things we started discovering as we ran into other companies. So for example, unbilled revenue. Most companies don't have unbilled revenue. Costco doesn't, but there was a company we valued that did. It wasn't in our model data. We had to add it, otherwise the model wouldn't balance. Okay, so 90 to 95% of the time that will not affect you, but if it does, you have to go find out what it is and add it to the model, and then plug it into your income statement or balance sheet to get it to continue to balance. You'll make sure that you don't have to do that. Check your CFI. If your CFI is balancing, you're good. Right? Final tab over here is called the ROIC drivers. This is the tree. So this model auto-generates the historical 5-year ROIC tree. These are the trees you were analyzing before. This is where it came from. Okay? Now, over here on the left, there's 2 tabs called assumptions and ratios. The ratios tab is where we're about to start, and it's key to what McKinsey and others talk about as a best practice in forecasting a valuation model. What we're going to do is, instead of forecasting income statements and balance sheets directly, we're going to forecast the ratios. And the forecasted ratios will create the forecasted statements. That's a best practice, right? So in order to forecast the future, we have 6 years of historical ratios of income statement and balance sheet, all as a percentage of sales, on this ratios tab. Okay? And then the other tab is called the assumptions tab. The assumptions tab are universal assumptions that span across the years that we'll be making in our valuation model. Those 2 tabs are going to be the ones that we change. Everything else we're not going to change, because again, a best practice is that you don't want to put assumptions that you changed scattered throughout your entire model. Because I will tell you, it will be late at night, you'll be very tired, your model will be doing crazy things, and you can't figure out why, because there's some random number assumption that you put somewhere in your model that you forgot about. And then you changed it for another company and you forgot to change it. So in order to mitigate against that, we're going to put all the places that we change into one of these 2 tabs. Okay, so that way we mitigate the ability to have to go find things that we need to change. The other thing is, you'll see that there's some cells that are yellow. I have chosen the color yellow, you can choose a different color if you want, to basically highlight to me that this is a cell that I can change. Because the other thing is, I don't want to overwrite something and break my model, because there's a lot of formulas and relative references here. And if I overwrite something, it could break the model. So what can I change? Yellow. Once we build the model. These are the assumptions that I can change, right? So that's the other thing you'll notice about the model, right? Now this is what we're going to start with, this is what we're going to build, right? So our first goal for Costco is to forecast the future. Now we're going to forecast 6 years, right? That is arbitrary and not necessarily ideal, but it's something we're simplifying for purposes of this class, right? Because we have to forecast the future of Costco. So what we're going to forecast is 5 years of year-by-year forecast, and year 6 is what's known as the continuing value or terminal value period. Companies last for a long period of time. So that's the point. The book even talks about this. When you do a valuation, you always forecast N plus 1 years, because that extra year in your valuation is the continuing value period. So for example, if I wanted to forecast 10 years, I would have 11 periods of forecast. 10 individual years, year 11, continuing value. If I wanted to forecast 7 years, 7 individual years, year 8 is continuing value. Always add an extra period. We're forecasting 5 years plus 1. That's why there's 6 years worth of data that we're going to start to forecast. The plus 1 is the continuing value period, right? Now, also we're, as much as possible, going to be using relative references. So now you're going to start doing what I do. So your homework is to basically turn in the same file that I create today on Monday. If you get to that point, you've completed your next homework assignment. If you don't get to that point, you have between now and 8 a.m. Monday to get to that point. On Monday, we're going to take wherever we end today and keep building. So don't lose that file, because then you're going to keep building that file. You have to do it yourself. So let's start forecasting the income statement. So let's go to the ratios page, make it a little bigger. All right, so starting with cell H1, I'm going to type in the word forecast to distinguish between the historical and forecasted data. Keep track. This is my forecast data. For cell H2, the first forecast year will be 2022, but I'm going to make it a relative reference. because my first forecast year could change. So I don't want to hard code 2022. So for cell H3 equals H2 is G2 plus 1. Previous year plus 1. 2022. All right, next, for revenue growth rate. Just as a placeholder, we're going to assume 2021 repeats itself for Costco. Every one of those ratios is a percentage of sales, with the exception of the revenue growth rate, which is change in sales, but it's still a percent. So for H3 equals the previous year. Let's assume Costco grows about 15.8% next year. Don't type in 15.8%, right? Because that number is rounded off. It's actually got more decimal places, so equals previous year. I'm also going to make that cell yellow to tell me that this is something that I could change. Okay? Now, we're then going to go to the income tab, which is our formatted income statement. Starting with cell H1, this is my forecast. Let's put the word forecast right. Equals previous year plus 1, so G2 plus 1. Right? And so here's how we're going to forecast 2022 revenue for Costco. So for 2022 revenue, H3 equals G3, last year's revenue, times, left parentheses, 1 plus, from the ratios tab, 2022 percentage change in sales, so H3, right paren, 262,891.75. Right? Now I'm going to select all of this all the way down and make this 1 decimal place just to be consistent with the previous years. Right? So here's the point. If Costco were to grow 15.8%, it would grow to 262,891.8. The ratio drives the number. Okay, very important to what we're about to do. Right? I don't want you to do what I'm about to do, but what if Costco were to grow 9%? On the income tab, 247,379.9. As we change the ratios, we will change the numbers. Next week, when we do the real valuation of Costco, we will change these numbers. For now, just so we all have the same file, we're going to leave the 15.8 equal the previous year as the placeholder while we're building our model. Okay? So we're going to keep doing this with other items for the income statement and the balance sheet. Let's continue building the income statement. I'm going to take a shortcut. Again, I don't like to take too many shortcuts, but here's another one that I'm going to take. Instead of forecasting cost of revenue and operating expenses, we are going to forecast EBITDA directly. All right? Because that's the important number, and the model doesn't really care about the 2 above. The 2 above lead to that number. Right? Now, if you work for Goldman Sachs and your clients are going to care about the cost of goods sold and the SG&A. You would have to forecast those individually to get to your EBITDA, right? But for our purposes, we're just going to forecast EBITDA directly this semester, okay? So to save time, go to EBITDA, which is cell H7, equals the previous year, equals G7, and make that yellow. Next, we're going to forecast depreciation and amortization as a percentage of sales. Equals H8 equals G8, and we're going to make that yellow, because that could change. Because we're forecasting EBITDA and DA, depreciation, what we're going to do next is we're going to solve for operating income or EBIT, because it's based on the 2 above. So we got 3 items, pick 2, solve for the 3rd. So in this case, EBITDA, H7 minus H8 is 3.4% for operating income, not yellow. Next, we're going to have to forecast the tax rate for next year. Equals the previous year's tax rate, yellow. That could change. Solve for no plat. No plat, you can see G11 is G9 times 1 minus G10. Operating income times 1 minus the tax rate is no plat. Okay? So for simplicity, being lazy, you can take column G11, copy it, paste over and solve for that, or you can retype the formula. But basically 2.6%. So operating income times the 1% tax rate is no plat, again, not yellow. Finally, non-operating gains and losses, which Costco does not have any, but some other company might. So for H12 equals the previous year, yellow. Those are the key income statement items we're going to forecast for 2022. Okay? Now, because we're just for simplicity using these as placeholders, I'm going to take column H, I'm going to copy it, I'm going to select all the way to column M, I'm going to paste it, and I now have 6 years worth of forecast data going through 2027, where everything just repeats itself on the income statement ratios for the next 6 years. That's our placeholders. Okay. Now let's go to the income statement and start filling that out. So, EBITDA dollars, which is H8, equals, from the ratios tab, 2022 EBITDA as a percentage of sales. So that's H7, times, from the income tab, 2022 revenue or sales is H3, 11227.9. So forecasted revenue, then as a percentage of revenue, that's the EBITDA. Okay. Depreciation, we're going to do the same thing. So basically on the income tab, depreciation in dollars off the income tab equals 2022 revenue, I'll go the other way, H3, times ratio H8 off of the ratios tab, 2200.9. Operating income, solve. EBITDA minus DA equals EBIT or operating income. So again, you can see the formulas over here on the left. So equals H8 minus H9 operating income $9,027,000,000. So very quickly, we now have a forecast for next year's operating income for Costco. Right? Now, we actually know that the next 5 items don't really matter to our valuation. Okay? Because when you did a CFI, operating free cash flow has nothing to do with interest income, has nothing to do with interest expense. That's either non-operating or debt expense. And there's some one-time items in here. Now, for window dressing, we're going to forecast these even though they don't actually impact our valuation, just so we have full income statements and balance sheets. Okay? But also, there's a couple more assumptions we're going to make. One of the assumptions that you make when you do an enterprise DCF is a constant capital structure over the life of the valuation. That's why we use a constant WACC. Constant capital structure, constant WACC. Right? Now, the capital structure should be the target capital structure. And again, for simplicity, we're going to assume that the current capital structure equals the future capital structure. However, if a company's capital structure is going to change to a new one, then that's the one you should actually put into your model. Okay? But regardless, since we're not going to muck around with the capital structure, we're going to leave the debt and equity alone, then the same debt's going to be out there, same interest payments. So our assumption for interest expense equals the previous year. If I ever make an assumption you think you should change it, go ahead. But I'm also minimizing the stuff that really is just things that don't matter. And it really doesn't matter to your valuation, believe it or not. And you'll see why as we build the model. It's your CFI. So back to the next one, interest income, same idea. I'm going to keep the interest income, whatever they're earning equals the previous year. FX gains and losses, 0. I don't know what's going to happen to currencies, neither do you. Okay? So how do I forecast a change in a currency that I don't know what's really going to happen to? And most companies tend to hedge anyways. Plus, Costco doesn't even have international sales. So for most companies, we're just going to put 0 in here. Again, if you think you know better and you can come up with a more realistic forecast, have at it. But I'm also going to tell you, it's not going to affect your valuation. Right? Next, income or loss from affiliates equal the previous year. Again, whatever they are, they're going to keep being. And then finally, non-operating gains and losses equals, from the ratios tab, Non-operating gains and losses as a percentage of sales, which is H12 for 2022, times for the income tab, H3. So if we take operating income minus interest expense plus interest income minus FX minus income for loss for affiliates minus non-operating, we get pre-tax income. Or if you want to be lazy, I've already put that formula into G16. So you can take G16, copy it, paste it over to H16. $9,074,000,000 in pre-tax income. It is on this $9,074,000,000 pre-tax income that they're going to have to pay taxes. All right, we forecast the tax rate and the ratios. So for income tax expense equals the 9,074 times from the income tab, for the ratios, income tax rate H10, 2228 in taxes, equals pre-tax income minus income taxes, income before extraordinary items, 6846. And by the way, if you look on the left, you can see the pluses and minuses as we go along. Right? Now, the next item there after the 6846 is called extraordinary loss net of tax. By definition, an extraordinary item should not recur. If last year's extraordinary item recurs, then by definition it's not extraordinary. And I don't know what random things are going to happen in the future. This is the company, so therefore 0. Now, if we're halfway through 22 and Costco says we're going to have some big restructuring charge, we always throw it in here, right? But generally, it won't affect the valuation. And 2, from a extraordinary loss net of tax, most companies, we can't predict the future. As I said, if they keep happening, they're not by definition extraordinary. They should be an operating. So our net income before minority interest is basically going to be the same as the extraordinary before income before extraordinary items, but equals this minus this, 6846. Minority interest. Because we're not changing the capital structure, whatever payments we're making to the minority shareholders, we keep making. Okay, so equals the previous year, keep paying the $71 million to them, and that gets us a net income. Equals the net income before minority interest minus the minority interest payments, $67.75. The next, now we're actually done with the income statement, okay? But we are going to look at dividends because we're going to forecast a change in retained earnings so we can actually get one balance sheet to sync up with the other, okay? So in order to get change in retained earnings, it's income minus dividends. So the next line item is our cash preferred dividends. Again, since we're not changing any of the capital structure, whatever dividends we're paying, we're going to keep paying. So equals the previous year. Now, Costco doesn't have any preferred dividends, so it's 0. Right? The next line item is other adjustments to equity. Okay? These generally occur when FASB changes GAAP, and as a result of that, the companies have to change their statements. Now, most of the time when this happens, 0 impact on cash. Right? And I don't know what's going to happen in 2025 to the FASB rules, so therefore it's hard to forecast, and so we're not. So just like extraordinary items, 0. Okay? And again, it really doesn't affect the valuation because if they do make changes, they generally don't affect cash. Right? Now, next, net income available to common shareholders. Take G25, copy it, and paste it in H25. So that's just net income minus the cash preferred dividends minus the other adjustments, so $67.75. Right. Next, we have dividends paid. Again, common dividends equal the previous year. But here's an important point. Notice that common dividends paid is negative $14.98. Notice that minority interest is positive 71. That's going to be a problem because if we take 67.75 and minus the 14.98 with a double negative, it will essentially add the dividends, not subtract the dividends. This is why you need to be aware of your data sources, right? I know that Bloomberg gives dividends as a negative number. I know that Bloomberg gives cost of goods sold, operating expenses as positive numbers, right? So when I'm adding and subtracting, I have to be aware of the data source that I'm getting the data from, okay? So even though the formula on the left says take net income minus dividends paid to get change in retained earnings, because it's coming in as a negative number, instead of subtracting it, I need to add it, add the negative number. So basically, H27 equals H25 plus H26, 5277. Does everybody see that? This, by the way, is why I told you to copy over G25 to H25, because the same thing is true for preferred dividends. If a company has preferred dividends, it comes in our data feed as a negative number. So even though you're supposed to subtract the preferred dividends to get the retained earnings, we're adding the preferred dividends because it's going to come in as a negative number. That's why I had you copy and paste. Okay? And that's what I'm saying. This is just something you got to be very careful about when you tie to a data source, because you're tied to the way the data comes in from that source. And if you then change your data source, that could cause problems. Because if you go to like Cap IQ from Bloomberg, Cap IQ might actually send you dividends as a positive number, and suddenly your model starts looking crazy. Yes? Change it where?
Like we changed the formula to add instead of subtract. Is that referred to changing?
Well, it is because we're doing two things. Great question. The reason why we're not changing it is, and we're just adding the formula, is just because we're basing it on what's coming in from this model data, right? And so I said we're tying this model to Bloomberg. So if you try and use this model outside of Bloomberg, could cause you problems, right? But that's the other thing. Bloomberg, which has been around since the 80s, and that's why I told you on the video, column A is the friendly name. That can change. Column B is the database field name. That can't change, because there are real firms in the real world that for the last 20 or 30 years have built models tied to Bloomberg, and Bloomberg can't screw up JP Morgan's models because they changed their database. So those database fields never change, and the format can never change as well. Otherwise, it will have ripple effects in the financial community, and a lot of people get really pissed off at Bloomberg, so they don't. So that's the other thing about Bloomberg, is like, once you know what that database field is, it's always gonna come in on that format. What Bloomberg does is if they ever need to change something, they'll create a new database field. But that original database field stays the same. So we can generally, as long as we're tying to Bloomberg, we can generally count on it. So that's why I'm doing it here. Sure. Any other questions? Yes? Just zero. And again, the problem is we don't know what they're going to be. And as I said, they generally don't affect cash, so we're not going to worry about it. Any of these that I say make zero, if you think you know what they are for a company for a year, you're always welcome to go back and change it. All right? But I'm also just trying to simplify this to the things that are going to matter to the real valuations you're going to do. Yes?
If the number is zero, like you said, you put in zero and the previous number is zero, could we just copy that over, or should we just?
It depends. If it's zero, equal the previous year.
Okay.
In some things I'm making zero, but sometimes it's zero because Costco doesn't have it, and I'm saying equal the previous year. Because if we plop it in another company, Verizon, it might not be zero for Verizon. They might have preferred dividends. And so therefore, I don't want to just put a zero in there because Costco has zero, because then when I have Verizon, it will be broken because it won't actually carry forward Verizon's dividends. Right. Other questions? That's where we're using relative references, by the way. Right. All right, so final step for the income statement. Go back to the income tab here. Take column H, select the whole column, copy it, go to column M, paste it. You now have 6 years of forecasted income statements for Costco, assuming those ratios come true. You would appreciate this next step in the midterm. Go to your TII. Take column G, copy it, go to column M, paste it. we now have 6 years of forecasted TII going through 2027 that balance. The only thing you got to do is take H1, say forecast, and then copy that across, just so you can distinguish between what's real and what's a forecast. But very quickly, we have forecasted and converted the income statement in the TII for Costco for the next 6 years. Now that we've finished the income statement, we're going to go on and create the balance sheet forecast. Same concept, we're going to start with the ratios. All of these balance sheet ratios are a percentage of sales, right? We actually do it for 2 reasons, but the most important reason is simplicity, because everything is a percentage of sales, makes our lives easier, right? We do the actual creation of the balance sheet, but there's another reason, which we'll talk about next week, why there's a huge advantage to doing it this way, right? But long story short, accounts and notes receivable, H14, these 10 or 11 balance sheet ratios, equals the previous year, and we'll make that yellow. Then we're going to take cell H14, we're going to copy it, we're going to select all the way down to M23, and we're going to paste it. So that basically just says repeat equal the previous year for all these cells all the way down through row 22. Now the one that I didn't copy over was row 23. Row 23 is invested capital divided by sales. That should sound familiar because if you remember in our ROIC tree, that's this, productivity driver, right? So what we've done here is I've put here under the ratios tab a solving of invested capital to sales to basically be my own personal sanity check. So for example, if Costco is spending 10 to 11 cents a year on capital to sales, I don't want to change these balance sheet ratios, so suddenly they're spending 30 cents of invested capital to sales. Okay, so it kind of looks at the ratios above and just says, what is the invested capital to sales based on all that forecast? So it just helps me be realistic when I am doing my forecast of a company. So it's just my sanity, one of my sanity checks. So just take cell G24, copy it, and paste it all the way across to M24. Now right now it's going to be 0 because we don't have a TFI. We don't have an invested capital. But once we build the TFI, this will be populated. Okay? Based on these balance sheet ratios, we're now going to start creating the balance sheet items in dollars. Okay? So repetitive process that we're going to do 11 times. Back to the balance sheet. The first line item in the forecast, so I'll write forecast on my balance sheet tab in column H, H1. My firecast, okay, equals the previous year plus 1, relative reference. Right. My first line item is accounts and notes receivable. That is H6 on the balance sheet. So equals, from the ratios tab, 2022's column H, accounts and notes receivable is H14 as a percentage of sales. Ratios H14 times, from the income tab, H3, which is 2022 sales. So 2595.8583. Okay. Just to be consistent, I'll take all these data points here from H4 to H33 and format this to 1 decimal place, just to be consistent with what I saw before. Okay. Do the same thing. For unbilled revenue, now it's 0 for Costco, but it may not be for another company, equals ratios, unbilled revenue as a percentage of sales for 2022, so that's H15, times, from the income tab, H3. Next, we have inventory, equals, I go the other way, equals income, which is H3, times ratios, H6, 16, which is inventory as a percentage of sales. I can go either way. But 20,742.5 million. Other current assets in dollars equals, from the ratios tab, H17 times income tab, 2022 sales, H3, 1736.4. Long-term investments equals ratios H18 times income H3. Next is net fixed assets, which is PP&E, equals ratios H19 times income H3. Next one is other long-term assets equals ratios, which is H20 times income H3, 2022 revenue. The next line item is accounts payable equals ratios H21 times income H3. Then we have other current liabilities or short-term liabilities equals, just row 21, ratios H22 times income H3. And finally, we have other long-term liabilities equals ratios H23 times income H3. All right, so very quickly, we have forecasted those balance sheet ratios as a percentage of sales and turned them into a dollar forecast. Okay. So we now have to finish the balance sheet, get it to balance, forecast it, and not have a circular reference. A circular reference is an invalid model. It won't be graded. Okay? You cannot have a circular reference in your model. You should never have one. So I'm going to show you how to create an auto forecasting model that avoids a circular reference. Right? So back to this. We're going to finish the liabilities and equity side of the balance sheet first, the ones we didn't forecast. All right? So starting with short-term borrowings, which is H20, equals the previous year. Because we're equals G20. Because we're leaving the cap structure alone, we left the interest alone, we're going to leave the debt alone. Whatever debt they have, they're going to keep. Okay? Same thing is going to be true for long-term debt. So for long-term borrowings, equals the previous year, 8966. Same thing is true for the pension liabilities. Whatever pension liabilities they're going to keep, equals the previous year. Again, Costco doesn't have any. Preferred equity. Whatever preferred equity they have, they keep. Costco doesn't have any. Equal the previous year. So H28 equals G28. Minority interest. Any minority interest investments they have, they're going to keep. So just like they keep the minority payments, they're going to keep the minority investments. Equals the previous year. Share capital and paid-in capital equals the previous year. Same idea. We're not going to issue or repurchase common stock. Not in our forecast. Right? So that leaves us with retained earnings. I have to solve for retained earnings this year. I know the formula for retained earnings is last year's retained earnings plus the change in retained earnings from the income statement, income minus dividends. So for cell H31 equals last year's retained earnings, so G31, plus from the income tab, H27, which is the change in the retained earnings in 2022. That's how much retained earnings should go up by. Income minus dividends. Okay? So it's going to go up by 5277 and should end at 19033. So that's my forecast for retained earnings for 2022. Okay? We are making an assumption in our model that everything flows from the balance sheet through the P&L. Okay? This is why I hate you accountants out there that are going to go to that fourth statement and make changes in equity that don't flow through the statements. It screws up our models. Right? We don't like that. Right? So don't do it. Right? But nonetheless, you're going to get paid to do it. It's how companies kind of manipulate things. But in any event, back to here. So the point is, I know it has to flow through the income statement conceptually, so therefore I solve for this year's retained earnings plus net income minus dividends, which is change in retained earnings, is next year's retained earnings. That's what we're solving for here. Now that we've done this, we can start adding things up. I can sum the 4 items above, and that is my total equity from preferred, minority interest, share capital, and retained earnings, and I have total equity of 25,924. I can sum my current liabilities, the 3 above, from accounts payable, short-term borrowings, and other current liabilities to get a current liability of 39,976.6. I can sum my long-term liabilities. Those are the 3 above. The long-term borrowings, the other long-term liabilities, the pension. I can take my current liabilities, which is H22. I can add them to my long-term liabilities, which is H26. And in H27, I get total liabilities of 48,902.2. I then take H33, which is I add my total liabilities in H27 to my total equity in H32, total liabilities and equity of 74,826.2. That's my forecast for that side of the balance sheet. Now, it is very important that our balance sheet balance. So I'm going to show you the trick to make the balance sheet balance. Take total assets, which is H16, equals H33. Balance every time. Okay? So we're forcing the balance sheet to balance. We're saying that the assets have to equal that. Now you might say, well, that was easy. So, but it does infer the concept of a plug, because when we add up all the assets, we got to add up to that amount. So that means one of those items is we're going to have to solve for to make sure it adds to that amount. It's called a plug. The item we're going to plug for, excess cash. Excess cash is our model plug. Okay? Which means we need every other balance sheet item except excess cash to basically get to our total assets. So let's look and see if there's anything else we didn't forecast outside of excess cash. One of the things we didn't forecast was operating cash. So we need a forecast for operating cash. You'll notice that there wasn't an operating cash on the ratios tab. If you go to the assumptions tab, operating cash is a percentage of revenue, 2%. And you might say, gee, why did he put it there and not on the ratios tab? The ratios tab are things that change year by year. The assumptions tab stay constant across your valuation. That's how I'm separating out the 2 tabs. Okay? So I'm saying that operating cash is constant, meaning if you need a week of cash to run the business, it's probably not going to change in the future. Okay? Now we're going to say 2% as a placeholder. We can always change the level of operating cash, but it's one level of operating cash across the years. Right? So that's why I'm using it as an assumption. So back to the balance sheet tab. For cell H4 equals from the assumptions, operating cash is a percentage of revenue, so B3, times from the income tab, H3. So 5257.8. Now, in just a minute, we're going to copy this over, and that's going to cause a little bit of a problem because we're referring to cell B3 and there is no C3. So when we copy it over, it's going to cause a problem. So here's what we want to do. We want to make this an absolute reference to cell B3. So in front of your B, put a $sign, and in front of your 3, put a $sign. That tells Excel to always refer to cell B3 regardless of where I copy and paste this through my model. Okay? I don't do this year by year. The other item that we did not forecast is goodwill. So for goodwill, equal the previous year. The assumption is that goodwill theoretically lasts forever unless it's impaired. So therefore, we're going to leave it alone. Even if it's impaired, it's a non-cash item, so it doesn't really affect the cash flow valuation. But nonetheless, equals the previous year. And I don't know what acquisitions that Costco is going to make in the future, so I don't know how much they're going to pay for them, so I can't forecast goodwill. So I just equal the goodwill. Now that I've forecasted all of the line items outside of the sums, except for excess cash, I can solve for excess cash. So excess cash, which is cell H5, equals total assets, which is H16 minus everything else. So H16 minus H4, operating cash, minus H6, accounts and notes receivable, minus H7, unbilled revenue, minus inventory, which is H8, minus other current assets, H9, minus long-term investments, minus, I think I made a mistake here, but net fixed assets, minus goodwill, minus other long-term assets. So 9776.8. Notice no circular reference. Right? I think I made the mistake and I put in this 1736 one row too low. So this ratios 817 times income H3 should actually be in cell H9. Move it up one. It didn't like that I did that. Minus H9. All right. Change my excess cash. I want to make sure I get this right. All right, so equals this minus this minus that minus that. Yeah, 8040.4, is that what you guys got? Okay, so 8040.4 of excess cash. All right, so now if I sum this up, I can take my total current assets, which is H10, and add everything above it, equals sum from H4 all the way down through H9. I take for my long-term assets, I can sum from H11 all the way down to H14. And if I want to do a double check, I take my current assets plus my long-term assets, and I should get 74,826.2. So because I plugged excess cash and added everything up, I still get to the same answer as the total assets. I'll get rid of that. All right, now that I have a balancing balance sheet without a circular reference, question? What we're going to do is we're going to take 2022, column H. We're going to select it. We're going to copy it. We're going to go to column M, select it, paste it. We now have forecasted balance sheets through 2027 for Costco based on those ratios. We then go to our TFI. I take column G, I copy it, I go to column M, I paste it. I now have forecasted and balancing TFIs going through 2027. Yes?
Back to the balance sheet real quick.
Yeah. By the way, before I forget, let me flip this to say forecast. Just I copied over the word history. and copy that across. All right, so back on the balance sheet.
For total long-term assets, I understand that we summed it, but for the history, it's all for the model data. Is that, are we just, because we're forecasting it, obviously it can come from the previous data, but would you be able to, if you were to sum it, would you get that same answer at the model data for the fiscal year?
You're talking about for the previous years?
Yeah.
It should, because that was the whole point of this balance sheet. Like, this balance sheet came from the model data, which if you add up all those categories, should add to the actual balance sheets of the company. Right? And so that's the point. We got to make sure that they balance both historically as well as in the forecast period. Because you can't have a standardized statement that's different than the one the company gave you. It's got to have the same assets and liabilities. All right. Now that we've done the TFI and the TII, we can go to the CFI. Again, you'd appreciate this in the midterm. Take column G, copy it, go to column M, paste it. We now have forecasted, CFIs going through 2027, that balance. Again, history, flip it to forecast. Copy that over. And then finally, we go to our economic profit. Column G, copy it. Column M, paste it. We now have forecasted economic profits going through 2027. So in about an hour, we have created for Costco a forecast based on ratios and assumptions for the next 6 years of their income statement and balance sheet and economic statements and cash flow statements. Okay? Questions about anything we've done so far? If you've gotten to this point, this is your next homework assignment. Okay? So if you're done in just a minute, you could actually submit it and you're done until Monday. If you're not done, you need to get to this point by Monday. Right? This is what you're going to be great on. Did you exactly match this? Here's a couple numbers to key off of. On your CFI in your final year, it should be 1688.2. Okay? I'm telling you, if you got that number, you probably got everything else right. It's easy to check. Right? You won't get that number if everything else doesn't balance. Right? Questions about this? Once you submit that file, then on Monday, we're going to pick up at exactly this point, so keep the file ready, and then we're going to finish off the valuation of Costco next week. Okay? Using more realistic numbers. Question? Balance sheet H5. Sure. So, final point. The Bloomberg Trading Challenge is back open again. By the end of today, you need to be less than $300,000 worth of cash. All right. So again, if you haven't started trading, start trading and continue trading for your second 6-week sprint. Same team, same captains, just your portfolios will reset back to cash. So get out of cash by the end of today. Okay. All right, questions about any of this? Yes.
For ratios of income statement, we're not doing a gross profit for this.
You're not doing a gross profit? No, for simplicity, we're just forecasting EBITDA, not the two items that go to EBITDA. In the real world, as I said, we would probably do that forecast. Here, the model doesn't care, and we're just going to simplify it to make it a little easier. Okay? All right, so if you're at this point, give me a minute. I'm going to set up the homework so you can submit this file, and then you can submit the next homework now. Otherwise, get to that point, submit that file, have a good rest of your week, and I'll see everybody on Monday.